Buying a home is often one of the biggest financial decisions we ever make, and it's a dream that many have held for years. But what happens when that dream collides with the harsh realities of today's difficult housing market? With high interest rates, high prices, and a shortage of homes, many find themselves frustrated and they end up rushing into a decision they later regret. This video will outline the essential steps that you need to make before purchasing a home to ensure your dream doesn't morph into a regrettable decision. And the mistakes and regrets are many. Check out these recent headlines. 93% of home buyers have regrets about purchasing a home in 2023. More than half of home buyers have felt in over their head financially since purchasing their home, and almost two-thirds have been struggling to make their mortgage payments on time. And while paying for their home, about half of buyers have taken out additional debt to maintain their lifestyles. Too many people probably didn't fully understand what they were signing up for and didn't properly prepare themselves. According to the St. Louis Federal Reserve, the median price of all residential homes sold in the third quarter of 2023 hit $431,000. In the third quarter of 2020, the median price was $337,500. That's a price increase of 28% in just the past 3 years. This rapid increase in prices is certainly not normal, though. Here's a chart based on data from the Federal Housing Finance Agency, which illustrates a massive price spike after 2020. However, when considering the compounded annual growth rate of homes since 1991, it only averages 4.4%. This recent surge in prices is compounded by the steep increase in mortgage rates. Rates hit a low of 2.65% in January of 2021, but as I make this video, the average just hit 8%. Home affordability is now exceptionally challenging. Let's examine the impact of the interest rates that we now are experiencing. Consider a $400,000 mortgage, which just 2 years ago could have been financed at 3%. At that rate, your monthly payment would be around $1,686. However, financing the same $400,000 at 8% raises your monthly payment to $2,935. That's a 74% increase in monthly payments for the same $400,000 mortgage. And this would result in you paying $656,620 just in interest expense alone over the life of the loan. So what do we do about all this? Well, before buying any home, let's review some essential steps on how best to prepare, because patience and planning can save you a great deal of money. Before these tips though, please hit the like button, subscribe, and when you're finished, please leave some comments below. Okay, let's get into it. First and foremost, building a strong credit score is essential. While the average 30-year mortgage rate may be currently sitting at 8%, those with a credit score above 760 can secure a lower rate of 7.418%, compared to 8.461% for those with scores between 640 and 660. The difference makes a huge impact. For example, on a $400,000 mortgage, this small difference means your monthly payment drops from $3,064 down to $2,774. That's a savings of $290 per month. Over the life of the loan, this simple preparation translates into a remarkable savings of over $104,000 in interest expense alone. Next, you want to tighten your budget on all unnecessary expenses and make a dedicated effort to save for a substantial down payment and the closing costs. The recent nationwide average down payment for a house stands at 14.4%. However, if you can't put down at least 20%, you'll likely be required to take out private mortgage insurance, or PMI. With PMI, you pay the insurance premiums. but the protection is for the lender in the event that you default on the loan. The specific cost of PMI varies widely based on your credit score and the size of your down payment. Let's consider a scenario with a good credit score in the 720 to 740 range. For a $400,000 house, a 5% down payment would result in approximately $231 per month or $2,772 per year in PMI expense. In contrast, a 15% down payment for the same house would lead to around a $65 per month expense or $780 per year for the PMI. This expense typically terminates once you reach 20% equity in your home, which would take about 13 years for a 5% down payment and about 7 years with a 15% down payment. So, with a 5% down payment, it would cost you $2,772 per year for 13 years, totaling over $36,000 in pure expenses. With a 15% down payment, it would be $780 per year for 7 years, amounting to about $5,460 in expenses. The difference results in a savings of over $30,000, and opting for a 20% down payment would eliminate the PMI altogether. Remember, a larger down payment not only reduces your total interest paid on the loan, but also enhances your financial security. For every extra $10,000 you can put down, you save $16,416 in interest at today's rates. With a very small down payment, you not only incur more associated expenses, but you also take on additional future risks. There's no guarantee that home values will increase in the near term, especially in a climate of high interest rates and the recent price surges. Some areas of the country have even witnessed slight drops in median prices recently. If your home value decreases, you could end up with negative equity, placing you at a serious financial risk. For FHA loans, PMI isn't required, but there's a typical upfront mortgage insurance premium of 1.75% of the loan amount, and everyone pays that regardless of the down payment. On a $400,000 mortgage, that's a $7,000 fee. Then there's an annual cost that varies based on the borrower, and the annual cost may be for the entire life of the loan if the down payment is too low. Speaking of saving for a down payment, it's crucial to be ready for the additional burden of closing costs. According to Bankrate, buyers' closing costs average 2 to 5%. If we considered the lower end of that range of just 2%, it still translates into an $8,000 expense on top of your down payment for a $400,000 mortgage. While it's possible to roll these costs into the mortgage, doing so means you'll be paying interest on that for 30 years. If you rolled $8,000 into your 30-year mortgage at 8%, it would result in over $13,000 in additional interest. You just turned $8,000 of expenses into $21,000 worth of expenses. And we want to remember it's crucial to maintain an emergency fund even after you've paid for the down payment and covered the closing costs. Life is filled with unexpected expenses, both related to the home and other aspects of life. On average, homeowners allocate 1 to 2% of their home's value for maintenance and repairs each year. Let's take the best case scenario again, 1%, which means $4,000 annually for that $400,000 home for repairs and maintenance. While these expenses don't occur every month, they can be substantial when they do happen. Being financially prepared for such contingencies ensures that when they do happen, you don't fall further into debt, trying to cover those costs. For first-time home buyers, many people investigate first-time home buyer assistance programs. They can be very helpful, but be very careful with these low down payment options some of these programs allow. The average down payment for a first-time home buyer only runs around 6%, but a lower down payment not only forces you to pay higher mortgage insurance premiums for a longer period of time, but the total overall interest payment will be much higher because you are financing a larger amount. FHA loans may sound tempting with down payments as low as 3.5%, but they come with that upfront mortgage insurance cost of 1.75% and annual insurance fees. Then there are VA loans, designed for service members and veterans, offering a 0% down payment with no mortgage insurance fees. But they include what's called a VA funding fee. It's important to note that the lower your down payment, the higher the associated fees you end up paying. VA funding fees can range from 1.25% to 2.15% for first-time VA loans. Depending on your down payment, on a $400,000 house with no down payment, this would be an $8,600 fee. With a 10% down payment, it drops to $5,000. While less money down sounds tempting, it results in higher closing costs, mortgage insurance, funding fees, and increased interest over the life of the loan. Being adequately prepared is really important. Borrowers who aren't well prepared will find themselves in a financially vulnerable position, and you will pay much more over the long run as others profit from your mistakes. Understanding and staying within a price range you can truly afford is also really important. Lenders ideally want your total mortgage payment, which includes property taxes, insurance, and an estimate for maintenance and repairs, to stay below 28% of your gross income. This is known as the front-end ratio. And then, once adding in all the other debt payments like credit cards, auto loans, or student loans, they prefer the total of all your debt payments to be under 36% of your gross income. This is called the back-end ratio. This combination is referred to as the 28-36 rule. In today's environment, staying within these ratios is extremely difficult, and in some areas of the country, nearly impossible. Some lenders may allow these ratios to go higher, but remember, as they increase, you're shouldering more financial risk and placing much more burden on your future self. Most people can usually afford a mortgage that's 2 to 3 times their gross income while staying within the 28-36 rule. For instance, if your income is $100,000, you can typically afford a mortgage that falls in the range of $200,000 to $300,000. Where you fall within that range depends upon your down payment, your credit score, current interest rates, property taxes, insurance, and the existing debt payments that you already have. This doesn't align well with the current market conditions, which is why the Home Affordability Index reveals this is now the toughest market in the past 15 years. So in today's markets, banks are permitting borrowers to stretch their debt-to-income ratios. While the ideal total of debt-to-income ratio is under 36%, some banks are now extending it to 43% and even all the way up to 50% to accommodate borrowers. For conventional loans, under 36% is the ideal back-end ratio, but it can go as high as 45 to 50% for well-qualified borrowers. FHA loans usually allow a 31% front-end ratio and a 43% back-end ratio, with certain exceptions allowing all the way up to 57%. VA loans generally recommend a 41% back-end ratio. But be careful what banks allow you to do. It's important to remember that debt-to-income ratio doesn't provide the full financial picture. They don't consider other expenses such as food, health insurance, utilities, gas, entertainment, retirement savings, and income taxes. People often become so focused on wanting to qualify for a home loan that they forget to account for all the other expenses compared to their actual take-home pay. You need to do an honest assessment of your finances and budget. It's best not to be taking your advice from a realtor trying to make a commission from selling you a home, or a bank trying to get you into a loan. Too many people are tempted to buy the most expensive home they can qualify for in terms of a mortgage. However, just because you can qualify for a loan doesn't mean that you can actually afford the house. If you're putting too much of your income towards making your mortgage payments, insurance, property tax, and repairs and maintenance, you won't have anything left over for things like saving and investing for your retirement and the other essential living expenses. By stretching yourself too thin with an expensive house, you're putting yourself at risk of damaging your net worth rather than improving it. You're going to want some wiggle room in your budget, and remember that saving and investing for a secure future should come first. We don't want to become what's called house poor. That can create feelings of stress and anxiety around your finances and make you feel as though you're just one setback away from financial disaster. In a recent Consumers Affairs report, 69% of homeowners feel house poor. 3 in 5 didn't expect repairs and maintenance to be as high as they are, and 3 in 5 are sacrificing essentials in order to afford their housing costs. Of course, a home can be a wonderful investment, but please be an informed buyer and understand all the costs that go along with owning a home beyond just the mortgage. Being well prepared and informed can mean the difference of fulfilling your dream of owning a home or falling into a cycle of struggling financially. Here's an example that might really surprise you. If someone took out a $350,000 mortgage for 30 years at 8%, their monthly payment would be about $2,568, and they would pay a total of over $574,000 just in interest. Now, if we would have financed that same $350,000 for 20 years instead, it does jump the payment to $2,927, but the total interest drops to just a little over $352,000. That's a savings of almost $222,000 in interest expense on just a $350,000 mortgage. Usually, if someone is in the position where they must finance a home for 30 years, they might be buying too much home for their income. It's just a very odd market right now. Usually when rates go up, home prices tend to go down. But the recession of 2008 and the ensuing foreclosure crisis hit home builders especially hard, causing them to underbuild for over a decade. They still have not made up the difference. This shortage has put pressure on prices. Would-be sellers, meanwhile, feel trapped. They have little desire to trade a 3 or 4% rate they may currently have for an 8% mortgage rate on a new purchase. This just adds to the shortage because fewer existing homes are coming onto the market. Remember that home ownership is a journey that goes beyond the initial qualifying for a mortgage. To avoid the common regrets so many people end up feeling, we want to prepare and fully understand all the additional expenses. Planning and preparing well can save you a great deal of money. If this isn't the right time for you, it may be better to continue to save and prepare for a better opportunity. I hope you hit the like button, subscribe, leave some comments below, and thank you for watching.